So let's shift some gears and we are going to move off of the market investment types, bonds, stocks, mutual funds, and the like, into what your authors consider to be more high risk investments. And in particular, we will start with real estate. There are a couple of ways of doing this. One of the easier ways of doing this is invest in a mutual fund that concentrate on the investment of commercial real estate. These commercial real estates appreciate in value. They're bought and sold. They create capital gains within the mutual funds, and they also collect rents, which adds income to eventually to your portfolio through mutual fund ownership. And that is the easier way to do this. The harder way of investing in real estate is to actually own um, the property consisting of land structures of which you have legal title to. You can individually invest in commercial or individual homes, if you will, and create a portfolio. One of the issues that you have in real estate investment is to price your purchase correctly. And one of the things, and the second issue that you have is how are you going to finance these investments? In terms of pricing your purchase correctly, we're going to use a method from chapter one called the discounted cash flow method, which is shown on the next slide. If you will, we are going to assume we're going to buy a piece of property, and this particular chart doesn't tell you what the purchase price of the value is, but we would need to consider that in our calculation here. But we're going to assume that somehow this piece of property generates us per year a after-tax flow of around $4,000 for the 5 years that we own this property, and then in year 5 we're going to sell the property for $230,000. This particular chart assumes that we're going to need a 10% annual return in order uh, to buy this particular property. We want 10%. And so what we're going to do is multiply, if you will remember, the cash flow times the interest factor to get to the the discounted after-tax cash flow. And we add these all up, and what this $198,343 suggests to us that mystically, somehow, whatever this is, if we want to have a piece of property that generates $4,000 roughly per year, and we need 10% return, and we're going to sell this in 5 years, that we should pay no more for this piece of property. We should pay no more than $198,000 for the property in order to get the mathematics to work out. Now, there are some significant disadvantages to investing, and if we can just talk about a couple of those. Houses tend to be illiquid. They are easy to buy in many cases, and perhaps difficult, particularly in economic downturns, to get rid of. Oftentimes they require large initial investments. If you think about your own purchases of a home, if you have one, you put a significant amount of money, in many cases, down in order to buy the property. There's a lack of diversification because while we're having multiple houses or maybe apartment buildings in our portfolio, it's still real estate, and so goes the market, so goes real estate. Oftentimes, you have expenses that are associated with trying to manage your tenants. There are unpredictable costs, storms, natural disasters, and the like. And in order to sell property, this high transfer cost means that there are costs associated with getting rid of the piece of property. Now, I will tell you that before technology became technology anyway, the way that you became a millionaire in the United States was to own real estate.